After holding steady for months, the Bank of Canada is lowering its key interest rate.
There was a clear sense that the balance of risk has shifted.
Following 7 rate cuts in a row, the central bank had paused back in March to weigh the fallout of tariffs on prices and economic growth. Now it's set the benchmark rate at 2.5%.
With a weaker economy and less upside risk to inflation, Governing Council judged that a reduction in the policy rate was appropriate.
Steep tariffs on autos, steel, and aluminum have crushed exports and business investment. And Canada lost more than 100,000 jobs over the past 2 months.
That's the main reason that the Bank of Canada is cutting rates, to get the economy moving a little bit faster. The bottom line is we should still expect some economic weakness in the quarters ahead.
At this Ontario manufacturer, sales are down 25% this year.
The industry in general is hurting pretty bad. The manufacturing in Canada has really no good stories to tell at this point. So it hasn't gotten any better, long story short. And obviously time is working against us at this point.
President Jonathan Azzopardi is skeptical this rate cut will do much for his business.
It's not going to make anybody, jump out of their seat and start doing investments.
Many variable rate mortgage holders, though, welcome the change. After tightening their belts when interest rates were higher, every cut offers more breathing room.
Anywhere from $50 to $80 will come back, like my mortgage will go down. The economy is not doing good, but definitely it's a relief. And every little bit helps.
The central bank says there are still considerable risks to the economy, but wouldn't commit to lowering interest rates again. Many economists say more rate cuts seem likely, though not guaranteed. Nisha Patel, CBC News, Toronto.
All right, let's bring in senior business correspondent Peter Armstrong. So, Peter, watching Nisha's story, you certainly get the impression there's only so much a rate cut can do.
In the short term, yes, right? Interest rates are a really blunt instrument. They take as much as like 18 months to really work their way into the economy. You need to sort of think of them as scaffolding that goes up around the economy to just help keep it on track, that if businesses and consumers are spending even a little bit less on their debt payments, they've got a little bit extra money, and that can help, and you scale it out across the economy. But remember, this is just the beginning. Most economists believe, we're going to see another 2 cuts between now and March. So this is just dipping our toe into the stimulative waters of interest rate cuts.
Okay, can you broaden out a little bit? Because we saw a similar move from the United States today, but we're talking, 2 different central banks, 2 different economies.
In 2 very different places, right? The U.S. economy, until very recently, hadn't even begun to feel any pain or any damage from the tariffs. The Trump administration says is never going to be, but we are seeing cracks. We are seeing the job market weaken. So the question became, was that pain averted or was it merely delayed? And if it's delayed, there's more yet pain to come down the road for the American economy. And remember, U.S. rates were way higher than they are here in Canada. They've come down to a range of between 4 and 4.25. Here in Canada, they're at 2.5%, so a big difference.
Okay, Peter Armstrong, thank you.
You bet.